Guys, we've just witnessed history once again, the largest sports contract ever recorded, and it does have implications for all of us as traders and investors. In today's video, we take a look at what that means for us, and we also look at the Golden Cross, something that doesn't happen that often, but when it does, it has profound implications for the rest of the year. There's a lot going on. Tom Lee's super bullish on Ethereum, and everybody is in the crypto markets. Should you be too? Let's take a look at why markets around the world are moving the way they are and what the data suggests happens in July. Stocks, commodities, and cryptos. Let's take a look at it right now together. See you soon. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, we have a lot to discuss as always. What a CTA is up to? Why does the biggest sports contract ever recorded in history have anything to do with markets? And of course, the latest macro. Let's get things started off though straight away with this big sports contract. $700 million in just 2 years. Almost the most ridiculous thing you've ever heard, yeah? But on top of that, this has precedence. And what I mean by this is we've seen big contracts before over the last couple of years, especially in baseball. But remember back when A-Rod was the star, he signed a big deal in the 2000s, first up in 2000 and then in 2007 for $275 million. Now, obviously, this is way more in a shorter period of time, but you've got to keep that date in mind, 2007. One of the classic signs of euphoria is often in the sports market. And what you'll notice is that sports gambling in particular has been on the rise in recent years. We've got a little bit to discuss on Vegas in just a few moments as well. But let's talk about this Golden Cross. Now, in the markets, everything's been really bullish. We talked last week about how the squeeze was coming through as soon as we broke through that all-important 60-60 level on the SPY. And then, of course, we moved higher. Well, it turns out that when you get a Golden Cross, which we're about to get, whether it's today, tomorrow, or the next day, then you actually see pretty good returns over the next 63 days. In fact, there is a win rate of 91%. And there's quite a few reads here. We've got quite a lot of times this has happened, and it's been a fairly good next 3 months. Now, some of the things that could be encouraging for bulls here, even if we do get a pullback, is that we've only had 4 new highs in 2025. Now, this is up to 5 at this point, but basically we have a period of time where traditionally there's only really been like one other case scenario for this being the top of the markets. 96% probability that we continue at some point to a new high before seeing any particular crash. So it's pretty important to always look at future gains to be there. And one of the main reasons is, remember, strength continues to create new strength. One of the signs of bull markets often is when bad news comes out and it gets bought, not sold, the market is climbing the wall of worry. Growth stocks are breaking out. We've been talking about that. That's pretty bullish. And pullbacks are possibly on low volume with follow-through days and tons of setups. And we do have a lot of setups right now. You've got breakouts in particular stocks. You've got basing patterns in things such as hypergrowth when you look at it versus SPY performance. And of course, you even have good stats coming into July. So let's talk about these July stats. First up here from the Stock Traders Almanac, we have the first day of July. So it turns out that 90.5% of the time, that's a pretty big stat, July the 1st is actually bullish. Now, of course, you don't go out and just buy the market based on this, but 19 up, 2 down, 0.44% gain on average. That's actually not too bad when it comes to the S&P. And as you can see here, Wayne Whaley, who we often use the data from, finds that, yeah, the first day in July, even if we go out even further to 30 years of history, you'll get a 0.47% gain. And again, 27 and only 3 losses. So 1st of July tends to be pretty bullish across the board. Now, why is the market going up by so much? Well, it's leaving people behind. Again, similar to 2020, it looks like retail is more correct than the street themselves. And this has led to CTAs, commodity trade advisors, being behind. So these are based on momentum funds, and they really should be buying more than they currently have been. As you can see here, the latest Goldman Sachs reports does have a little bit of bullish case scenarios, but it also has some pretty bearish ones as their most likely scenarios. And what we've seen recently is the CTAs have been left behind. Now, if these guys have to purchase in, yeah, it could create even further squeezes on the markets. And you'll notice it's at that all-important breakout zone here for the CTAs. So if that does break out, we'll report it. and you guys will know straight away. Make sure to sub if you're interested in that stuff. So the CTAs are behind, the hedge funds are totally offside, and investors or institutional investors went crazy last week buying tech because they are so far behind this rally. They really stopped buying somewhere around the 5,600 to 5,660 level, and they're now quite offside when it comes to this market. Let's have a look at the S&P 500 when it quickly recovers and what it tends to do. You'll notice here that of all of the other reads, 98 most notable, because of course it was the tech boom, and now we feel like it's in the AI boom, that we often did see a little bit of a pullback a little bit later on. So somewhere around this period in time, we sometimes went up a little bit more, but then we would actually drop back off. So yeah, we're coming into the most important period, the Q3 period, earnings, potentially tariff discussions as some of those are rolling off. Inflation, obviously, whether that's coming back. We've got some great charts on the weekend video to talk about on that one. And of course, whether we're going to see a change in the Fed. Now, if we do see a change in the Fed, the market's starting to price in quite a lot of interest rate cuts. And it brings us back to where are we in terms of a standardized bull market? Are we at the end of one? Are we at just the beginning? Is there still years and years and years of growth to happen? Well, this does tend to be a sidewaysing period of time. So while the market is rallying and everyone's super euphoric, while we think there could be more gains, potentially 6,300 is on the cards here, there's going to be a point where the market will have to pull back. Firstly, to allow hedge funds and institutional investors in, but secondly, because the fact is that the market is quite overbought. And while it's squeezing right now, it doesn't squeeze forever. I've noticed, and I'm sure you've noticed as well, the amount of bullish articles written over the weekend was extremely high. Morgan Stanley, Goldman Sachs, JP Morgan, so many big banks coming out saying there's so much more room to run. And while that might be true, remember, they do love to write these types of articles. I always say if it's in the press, it's often in the price. Here's what happens when you get a good return in May and a good return in June. And basically the stats for the next 6 months are usually pretty positive. I have got quite a lot of other defensive reads that show that the market is quite euphoric. And it tends to be that July comes out of the gates pretty strong. The back end of June into July comes out pretty strong. And then we go into a questionable period. And this is the Q3 period that we've talked about before. And one of the things about this period is it's pretty expected. Year threes of bull markets are terrible. Traditionally, they're incredibly choppy and they're great for traders and investors like you guys if you know what the hell you're doing. But they're absolutely terrible for someone that just says, wow, I'm just going to buy everything and it's all great, all green, all good. And the reason why they're not good is because they tend to be a digestion year. We've had two 20% back-to-backs. When that happens, we usually have a sideways year. And while this is becoming more known, of course, we've talked about this since the back end of 2024, it still could mean that we have some problems in Q3. If I had to guess at this point, I would say it's going to be around the earnings season, which we'll be covering in great detail. So, of course, that's going to be a zone that we'll focus on. Inflation, as you guys know, could be bottoming here based on that stat from the 70s. If we have bottomed off here, we might see stabilization and then potentially reinflation. This could be a big problem on the future horizon, but it's only one read. But I think really where the biggest problems are, other than the sports contracts, which are just absolutely big nowadays, they're just wild, is what's happening in crypto. Now, I say it's a problem because I think ultimately, and I asked you guys this, a lot of you agreed that it's probably going to end badly.